Hello friends, welcome back to Mindful Finance. Today before starting I'll give a simple story. There are two farmers. One farmer harvested wheat grain. After harvesting the wheat, he just kept it in his warehouse and he felt that okay, so this is the time everybody will be selling the wheat. So let's wait for some more demand so that we can sell for more price. So this was his thought process and he just waited for the right time to sell. The another farmer who just doesn't care about the timing, he just focused on the seasons and the demands. Whichever seasons benefit for a certain type of crop, he planted those crop and he harvested and he sold those things. And he was consistently like making some profit from the harvest, and he started to build his own wealth. But what happened was after some time, the person who kept his wheat slowly it got to get spoiled. He started to worry. He had to sell the stock the less price and he lost his even the invested money for the crop. This is a story, important story to understand. This is what we are going to discuss. We are going to talk about Peter Lynch, who is a very renowned investor who worked for Fidelity Investments for a long term. He's been called as a investment guru. He has written multiple books. All books are like New York bestseller. So this video is going to cover the strategies which Peter Lynch followed. So I'm Sundar and you are watching Mindful Finance. So coming back to Peter Lynch and the farmer story. So you would have noticed what was the problem with the two farmers. The one farmer waited for time and the other farmer he just went with the flow and he understand which season has a good gives with what kind of a crop. So what you saw the short story about the two farmers. Now you would have understood the difference between the two farmers. The one farmer tried to time, the other farmer just went with the flow. So which one you want to pick? So that is the important thing you have to learn. So the first point, what Peter Lynch is saying is understand the market. Without understanding the market, don't enter into the market. Market is something that it's unpredictable. So don't try to time a market. Be consistent, be always go with the market. So don't try to, okay, the market will go down, so then I will buy, or when the market goes up, then I will go and buy. So don't just try to time the market to enter. So that is the first point. So if you see this chart, the last 50 years of how the S&P 500, the US market behaved, if you see, there are almost like 10 events happened in the past, which are called as opportunities, where the market fell a lot. So there was a research conducted with 68 researchers and confirmed that less than or around only 42 of the people, 42 of the researchers, there were at least try to predict 50% of the market, whether when it will go down, or remaining 50% couldn't able to predict the market properly. So that means during this time, they have missed a lot of opportunities. If a person stayed in the market without timing or anything, would assume that would have earned $100. If the person tried to time the market, would have made only $50. So that much of difference it's been shown with the people who are tried to time the market. So that is the key point of Peter Lynch's strategy. Next point is for market within India or global. It's a very wide thing. There are n number of industries, n number of sectors, right? So you have to be clear in understanding the concepts of sectors, concept of indexes, right? So you have to be very clear about all those things. Without that, again, don't try to invest or don't try to start your investment journey. The second point what Peter Lynch says is learn from experts because they have already experienced a lot of things. So learn from them. So example is Warren Buffett. The key learnings, a key point always Warren Buffett mentions is invest in business which you understand well. If you are not having a clarity of a business, don't enter. I'll just give a sample. How many of you know this company? The people who started the investments journey earlier, they would have known about this company. The reason is Nirma is a washing powder and it used to be there for everybody's home. It's very simple to say that pick a stock, pick a company which you daily watch in your home. You use in your home, because Nirma was a product, no home without Nirma. So that was the scenario used to be. It was a famous washing powder. But what happened, once it was used to trade around 800 rupees, it was completely removed from stock exchange, and people got 235 rupees as the exit at that point of time. Even a good company faces such a drastic scenario. Even if you take an example of Yes Bank, Reliance Infra, so there are a lot of stocks are there which gone like this. So you need to be very careful in picking a stock, because you need to follow them. If you are investing in such a stock, be aware of what you are doing. You need to be clear about that company. You need to keep a watch on that company. You need to keep observing that company. If you are not clear about that, you just go and pick a stock which you are regularly using. It's available in your home or something. So don't just blindly go in that thought process. People used to say, right, so just watch morning what you are, for brushing what you are using, so for soap what you are using, cooking what you are using. So using that product, you buy a stock. It's a good tip. I'm not saying it's a bad, but don't just blindly go and fall for that. There used to be a scenario. We used to have Gold Spot, Torino. These are the soft drinks we used to drink. Earlier, Coca-Cola entered into the market, but they couldn't able to survive in the market. Warren Buffett, Coca-Cola is a main stock, but in India they couldn't make a market. It was a lot of volatility in soft drink industry, so nobody couldn't able to find a better company for soft drinks. It might be working for another country. You don't expect the same thing can happen in our country. Follow the company, follow what experts are doing in that particular thing in your area, in your surrounding. Okay, don't just follow a herd. Next tip is very important, which is called patience. Without patience, if you don't have patience, again, don't enter into the stock market, because you will lose your entire money. I'll give an example of Dabur. Okay, if you pick a Dabur, during 2008, it used to trade in around 29 rupees. If you would have invested just 10,000 rupees at that point of time, now the money 10,000 would be around 1,83,000. So you need a patience. It's not like very blindly you just go and put your money. As I mentioned, you have to keep a tab on your company. Like Nirma, it can fall at any point of time. So you need to be very careful about that. But if you have picked up right company, if you have picked a known company, then this is the scenario. Similarly, if you would have invested Dabur as a SIP, like 2008, you invested 10,000 rupees. Similarly, every year, if you would have invested 10,000 rupees, your investment amount would be 1,60,000, and the current it would be 29,31,000, and the return alone is 27,71,000, and its XIRR 30.32%. You will never get that kind of a return. So that's a key point. It's about starting early. So when you start early, that is you will have long journey to go. You'll have more time. In stock market, time is very important. There's a research. It says that if you start investing, it will take 17 to 18 years to reach 1 crore, and it will take another 5 years to get another 1 crore, and after that it just takes 2 years to get another crore. So that means almost like in 25 years you will have 3 crores, and after that the compounding happens very aggressively. So in first 17 years is the patience. The first 17 years is very crucial for you. So if you start early, and you can get financial freedom very early. So that is why investors says that start your investment very early. When you start earning, immediately start the investment. And the previous example, as I mentioned, when you are investing, use your everyday example, like what you are using daily. What are you consuming daily? What is your demand? If you are buying a soap, just check who is the distributor, so that you can find out the company name and you can find the stock name. So like that, for example, if you take Ashirwad Atta, it's made by ITC. A lot of people doesn't aware that ITC has so many products in the line. Everybody thinks that only cigarette is the main product for them. So invest in a company which you are aware, and try to analyze the stock, try to understand the company and invest on those stocks. So next point from Peter Lynch is the importance of research. Without research means it's not just you create a lab and do a research, right? It's a simple analysis. If you pick a company, try to understand what their company is doing. Find out what is their goal. Find out what is their vision. How they are making the money. What is the 5-year plan. What is the manufacturing plant is about. How much debt they are having. How much market share they are having. How much promoter holding. What is the operating margin. Right? Just try to understand the very basics of any company which they are doing. Without that research, again, don't start your investing. And also understand the economic and political aspects. Certain things may affect your stock because of some political decision. For example, if you take a public sector like a gas, LPG, government will set a price for that one. So the company will not have a pricing power. So only government sets the price for that one. So in that case, the company has a very limited capacity to increase the price and gain more profit. Those kind of aspects you need to be aware and clear about the company. So next one is, after doing the research, now you have to select the right company. If you don't pick the right company, it may go like Nirma or Reliance Infra, Yes Bank or something. And the main key point here is, as I mentioned earlier, pick the stock or pick the company which you are aware of that. N number of stocks. Don't get FOMO, like fear of missing out. Just focus on your own stocks, your own company which you are aware of that. That's enough for you. People want to do diversify and try to invest in N number of stocks, and it's very difficult to track and understand the company. So don't do that. The main thing is, after picking the stock, understand the growth potential. Find out in 5 years how the company is going to perform. What is their growth plan is. Are they going to consistently perform the next 5 years? Or they are building an infra such a way that in the future they might increase their capacity. Think about in multiple aspects of the growth, because some companies may get stagnant, it may not grow. So that is very important for you to criteria to pick a company. Next thing is volatility. Market is always volatile. If you get a panic of market going down, don't get into the stock market. So today the stock might be trading at 100 rupees, and within a month or sometime it may go to 20 rupees. Unless until you are not having a complete clarity of that one, don't enter into the stock market. So be prepared for ups and downs of the stock market. And if you don't have a conviction of a certain company, don't invest in the company, because you need to go to bed peacefully. If you are not clear about the company, what they are doing, don't invest in the company, and you'll get panic when the stock goes down. The key point is, invest money only which you don't want that money for next 1 or 2 years. If you want some money for immediate emergency kind of thing, so have a dedicated emergency fund. For example, at least the expense which you occur for 1 month, multiply by 6. That much of amount you need to always have in your emergency fund. Don't put every single penny into your stock market. Later point of time, the market may go down, and if you need money, when you are withdrawing the money, you will be in a loss. So don't try to do that. So always use money which you don't want for next 1 or 2 years. The final thing is about strategy, investment strategies, which is very important. You have to plan your investment, whether you want to invest in equity, whether you want to invest in mutual fund, whether you want to invest mainly for tax save. Within the mutual fund also, you have different types of strategies called STPs, systematic transfer plan. If you have a bulk of money, like say 10 lakhs, you can have 10 lakhs in a liquid fund, and every month you can transfer 3,000 or 5,000 to an index fund, so that the liquid fund will give you 4 to 5%, and you are also doing a SIP. So you just relax and get the money compounding. Hey, this is one kind of strategy. And the other thing is about the PE. When the PE goes down, if a PE is low, like price to earning is low, and if it's undervalued, go and ready to buy that stock. But don't blindly go and buy a stock which is having low PE, because the company might be underperforming, or might be like Yes Bank or Nirma, and don't go and blindly. If it's a PE, just go and don't invest on that. If you are aware of that company, and if the PE is low, then go and buy. Hope you understood what we discussed. Let's summarize what we discussed today. First thing is, understand the basics of stock market and investing. Second is power of patience and research. Third is understanding the long-term benefits, like start early and stay for long term. The next one is a compounding, like power of compounding, how the money grows. Like I give an example of 18 years to 25 years. The next one is understanding the market volatility. After that, using your personal experience, how can you find a good stock. The next one is economy, how our economy can affect. If you take an example of IR and IRCTC. IRCTC is a railway company and IRFC is a finance company. If IRCTC is down and IRFC cannot perform, if government says or government stops some plan for railway in the budget, if they mention that okay, this year we are not going to do R&D or we are not going to plan anything for railway, then RFC may face a problem. So think this relation. So that is another thing. And invest only what you know. If you don't know about the company, don't invest. The last one what we discussed was the strategy about mutual fund, STP, and PE ratio kind of thing. So this is what we discussed. Hope you understood. Now you got some kind of clarity and about how to plan for your investment. Hope you like this video. Comment if you have any questions. Don't hesitate to write comments on this video. If you like my video, subscribe to my channel. Don't forget to press notification icon. And if you like this video, share it with your friends and colleagues. Thank you.